What's up, everybody? Dave Ramsey is obviously a well known name in the world of personal finance. Well, Dave has some pretty strong opinions, and I happened to stumble across one of his videos that I humbly disagree with, and so I wanted to kind of do a walkthrough reaction, something sort of new that we're doing on this channel, but wanted to do a sort of walkthrough reaction on his views of a mutual fund versus a exchange traded fund or ETF, and sort of why I lean towards ETF. I think Dave does a lot to help people come out of very troubling financial situations, and I think he should be commended for that. However, I frankly I do disagree with him when it comes to this particular thing. So let's dive in and kind of take a look at the video, and I'll kind of walk through as we go.
Dave, do you recommend mutual funds over a comparable ETF? Well, an ETF, Dustin, as you may know, is an exchange-traded fund. And what it is, it turns a mutual fund into a stock of sorts, and enables you to jump in and out of a mutual fund without, or the equivalent of a mutual fund, without fees. The vast majority of ETFs are based on indexes, like an S&P 500, as an example.
I'll pause here and say, he's absolutely right in terms of how ETFs started. I will say there has been a big boom in terms of more actively or strategy managed ETFs. One of the most popular ETFs or exchange traded funds of 2020 was ARK funds, which basically invest in innovative technologies. They may have kind of sort of index, but they're in that innovative technology space. But really, it's an actively managed fund. But yeah, he's right in terms of how the structure works. It is basically a mutual fund that can trade on the stock market. And trade similar to a stock, but you can get in and out of it at will.
So a no-load S&P 500 versus an ETF that is in a S&P 500, there's virtually no difference in them. And so do I recommend good growth stock mutual funds that outperform the S&P above an S&P 500 index, ETF, or fund? Yes. Yes, I own many mutual funds that outperform the S&P 500.
So I'll pause here so basically what you're saying is, yeah, if we can get a mutual fund that outperforms the S&P 500, why would you own the S&P 500? For those of you who don't know, let me backtrack real quick. So the S&P 500 is the 500 biggest companies. It's just an index or a way of tracking, say, the 500 biggest companies in the U.S. stock market. So instead of trying to do better than the U.S. market or better than any individual companies, basically what an S&P 500 index does is like, well, screw it. Let's just own the whole S&P 500 or the whole 500 biggest companies and share the gains and losses of those companies. So he's saying, well, scrap that idea. Let's invest in mutual funds that outperform the S&P 500. All well and good, but you can find mutual funds and investors that do outperform the S&P 500, but a lot of mutual funds are what we call closet indexers. Basically, they get so big that really there's no way to diversify into enough high growth companies to, because a lot of high growth companies are smaller companies. So if you dump $1 billion into one, it's no longer a small company that's going to have high growth. But also, so one, they tend to mirror the S&P 500 just with fees anyways. But also about 90, I forget the exact statistics, so don't quote me here, but about 95% or some of mutual fund managers fail to beat the S&P 500, so actually underperform and charge high fees on top of that underperformance. But anyways, let's continue on.
And they're not that hard to find. A lot of funds don't outperform.
I would disagree. They are very hard to find.
You should not buy those. But ETF is not a guarantee.
That's very much easier said than done to find ones that will beat the S&P 500. Hindsight's 2020, whereas what tends to happen is people buy the mutual funds that have done really well. But again, kind of going back to the size thing, those have also gotten popular and tend to underperform once they become popular. And so finding the ones that will do well in the future, no one's got a crystal ball.
Guarantee. And if you're going to jump in and out of the stock market, you're not following anything I teach you. Now, the ETF is good for that. The exchange-traded funds are very good if you want to jump in and out because you got no fees and you're trading it like you're trading a mutual fund like you're trading a stock then.
So here he's basically saying because an ETF gets in and out, or you can't get in and out like a stock, mutual fund only trades once a day. So it's much harder if there's big market swings to get in and out of that fund. But there's nothing stopping you from just holding an ETF. So you can hold an ETF for as long as you want, just like you can hold a mutual fund for as long as you want. So there's no real difference. I don't think this is a valid point.
I don't recommend timing the market.
I would agree.
I don't recommend jumping in and out of the market. All the data shows us that is not good investing. That's speculating. And speculating on the S&P 500 is pretty stupid.
I would say I disagree here. So trend following is a type of investment strategy. Trying to time based on your gut has been proven over and over to be terrible, which is why 95% of mutual fund managers don't beat the S&P 500 because they operate on gut or intuition. There are algorithms out there and ways of investing called momentum investing or trend following that has been statistically proven to beat the market if you time it right, just by getting out of the markets before big drops, because as your money goes down, it becomes harder and harder to dig out of that hole. So basically, as long as you're keeping your money, it's much easier to grow your money than having to dig out of your hole first and then grow your money. So buy and hold's not always the best strategy.
Straight up. Because now you're really trying to time the overall market, not even a segment of the market. And so really low probability of you doing that. So if you want to buy an S&P 500 and you want to do it with an ETF, sure, it's an efficient way to do it. I'm not mad about it. I've got a lot of money in
agree there.
500s because they have low turnover ratios, and I don't get taxed on them until I pull the money out. And when I do pull the money out, I get taxed at long-term capital gains if I've held it for at least a year. So I use it because it has a low turnover ratio.
Also, great point.
To use ETFs instead of the 4 types of mutual funds that I recommend, no, I would never do that. Because the 4 types of mutual funds that I recommend, I can find them that outperform an S&P 500, which 98% of you dealing with ETFs are doing an S&P 500. Spider, that's what you're doing. And that's okay. It's all right. It's not bad.
These days,
it's just not the best.
These days, there's thousands of ETF options. So I say this video is a little old, so I'm going to say that doesn't necessarily hold relevant these days.
Personal 4 mutual funds in my 401k have outperformed the S&P 500 by 1.5 net of fees. After all fees,
So 1.5, and this is where it gets really interesting, and this is why I like debunking the mutual fund prowess over ETFs myth, because what he's saying is I can beat the S&P 500 by over 1.5 taking fees out of the equation. So the reason ETFs tend to be more popular is because they have lower fees. Well, ultimately it's about value and how much money you end up having in the bank, where if you can outperform that, wonderful. But what he's talking about is fees and fees alone. So something I want to show here is there's actually other kind of hidden costs to owning a mutual fund. And so this study was done by a couple of CFAs or chartered financial analysts. And basically what they found, so these are kind of the average costs of owning a mutual fund. So what he's referring to is like net of all fees. So basically he's referring to this fee. So, a ETF would have to overcome this 0.9% fee. So he's saying that he's getting a 1.5 above, say, this 0.9%. So AKA is outperforming the S&P 500 by about 2.5%. Okay, which is great. But what he's not mentioning is that there are transaction costs. Yeah, he kind of pushes low turnover, but there's still going to be transaction costs, which basically because as how much a mutual fund works is, as money comes into it, they have to buy and sell those stocks. So that generates taxes, that generates fees baked into that mutual fund. And what the CFA discovered is that overall ends up being about, on average, 1.44% of your returns. So just off that alone, now he's in a situation where he's even with an ETF. But here's where it gets interesting is that cash drag. So mutual funds have to have a boatload of cash on hand because as a mutual fund sells, they have to be able to hand you that cash right then and there. Whereas ETF works a little differently just because basically you're buying and selling from other investors so that other investors give you the cash. The ETF is not giving you the cash. So there's a cash drag by holding, the mutual fund having to have so much cash on hand that they're actually losing performance. So now he's actually underperforming an exchange traded fund equally, based on his numbers that he's quoting, and that's in his 401k that he's mentioning. But if you add in it in a taxable account, those buys and sells within the mutual fund that I was talking about, those get passed off to you as an investor. So that means you have an extra 1% on top of that. So now you're underperforming by about 1.8%. So his argument for mutual funds starts to die pretty quickly when you start looking at the full numbers.
In the last 10 years. It's really not rocket science to find them.
Disagree.
So, you know, no, I'm not a big ETF guy, and that's the reason, because I'm not a big index fund guy, because I can find funds that outperform them. We recommend you spread your investments into four categories: growth and income, aggressive growth, and international.
Here's the other fun thing. This is probably the last thing I'll mention on this video, but basically he has kind of those 4 different segments of stocks. Well, these days, because of how correlated the markets are, aka you have US, you have international. Well, 20, 30 years ago, you used to get a lot of benefits of owning both. But nowadays, when you have a situation where McDonald's gets about as much revenue from, Europe and China as it does the US, and has about as much real estate there as well, well, you start to, those lines start to get blurred where you're not getting the same, differences between the different investment types, like such as having international. So all in all, again, I think Dave Ramsey has a lot of valuable things to add to, people that are really struggling financially. But when it comes to his investment strategy, I don't necessarily disagree, or I don't necessarily agree. And, I think this is one of those situations where, this is kind of why. I'm definitely a proponent, and I highly recommend, viewing exchange traded funds over mutual funds as a whole. I will say there are mutual funds that are great investments, and there's different types of investments that are better in a mutual fund versus an exchange traded fund. But as a whole, I mean, if you're looking at U.S. stock market or just a broad international markets, 9 times out of 10, a exchange traded fund is going to be the better option. But hope you found this video valuable. If you did, make sure you like and subscribe, and we'll see you in the next video. Cheers.